Have you ever thought about investing but assumed you needed thousands of dollars to get started? The truth is, it's not about how much you have. It's consistency that makes all the difference. With just $100 a month and the right strategies, you can build a solid foundation for future wealth. In this video, I'll show you how small regular contributions can grow significantly thanks to the power of compound interest and smart investments like ETFs. How many times have you hesitated to invest because you thought it was too late or that your money wasn't enough? If you want to learn how to take the first step without needing a large sum, stay until the end. I'll guide you with practical examples and simple visuals so you can understand exactly how it works and start today. Now let's explore why so many young people give up on investing before they even begin. Many believe they need large amounts of money to make any real difference in the future. For example, imagine saving $100 a month but thinking it won't have any real impact. That's a big misconception. The problem is that this limiting mindset prevents people from taking advantage of the power of time and consistency. How many times have you avoided investing because you thought your money was too little or that it wasn't worth starting? This doubt is more common than you might think, but the good news is that small, consistent actions can lead to surprising results. To better understand this, we need to talk about the concept of compound interest. Imagine your investments are like a tree. At first it seems small and insignificant, but with patience and care it grows and multiplies. Compound interest works the same way. Your money earns money over time. To visualize this, let's look at a comparative graph. If you start investing $100 a month at age 20 with an average annual return of 7%, you'll have accumulated over $500,000 by age 60. But if you wait until age 30 to start, the total amount will be significantly lower. This example shows that time is your greatest ally, and starting early makes all the difference. But where exactly should you invest? One of the best options for beginners is ETFs, or exchange-traded funds. These are funds that track market indices, like the S&P 500, allowing you to invest in a diversified portfolio of companies at a low cost. Additionally, they have low administrative fees and are easy to access through online brokers. Other options include index funds, government bonds, or automated investment apps. For instance, imagine you decide to invest $100 a month in an ETF that replicates the S&P 500 index. Over 40 years, even with short-term fluctuations, your investments will likely grow consistently, ensuring a more secure financial future. So, how can you get started today? First, set a realistic budget. You don't need much. $100 a month is enough to begin. Next, choose a reliable investment platform such as an online brokerage or beginner-friendly apps. Set up automatic contributions to ensure consistency, regardless of changes in your routine. Finally, focus on the long term. Avoid the temptation to withdraw your money early. Remember, the power lies in time and patience. With these simple steps, you'll be on the right path to building wealth. Unfortunately, there are still many myths and doubts that prevent people from starting to invest. One common myth is that you need a lot of money to invest. In reality, modern platforms allow you to start with small amounts, like $100 a month. Another widespread misconception is that investing is complicated and only for experts. Today, intuitive and accessible tools make the process much easier. Lastly, some people fear losing money. While no investment is completely risk-free, long-term options like ETFs tend to be less volatile and safer over time. Additionally, financial education plays a crucial role in investor success. Continuously learning about personal finance can transform your perspective and improve your decision-making. Books like The Intelligent Investor by Benjamin Graham, investment podcasts, and free online courses can expand your knowledge. Small lessons, such as understanding basic concepts like discounted cash flow or margin of safety, can lead to significant changes in your financial behavior. Remember, the more you know, the less fear you'll have. Another important point is learning to control your emotions when investing. The financial market is volatile, and economic crises can cause panic. However, impulsive decisions during uncertain times can jeopardize your long-term goals. An effective technique is to maintain a clear plan and review it regularly. For example, Maria, a fictional investor, faced a global economic crisis but stayed focused on the long term and resisted the urge to sell her assets. Today, she reaps the benefits of that discipline. Ahead, it's important to stay informed about emerging trends in the investment world. Cryptocurrencies, fintech, and ESG, environmental, social, and governance investments, are rapidly gaining traction. These options can complement traditional strategies, but it's essential to remember that the basics never go out of style. Focus on building a solid foundation with ETFs and other low-cost investments before exploring riskier alternatives. Keeping up with innovations is important, but never lose sight of your primary goals. In summary, the secret to building wealth with little money is consistency, the power of compound interest, and smart investments. Starting now, even with small amounts, puts you ahead of most people your age. Remember, the future begins with the choices you make today. Don't wait for the perfect moment. The best time to start was yesterday. The second best time is today. If this video helped you understand how to start investing with little money, leave a like and share it with other young people who also want to build their financial future. Subscribe to the channel for more content on personal finance and smart investing. Remember, the future starts today. Invest in yourself and build your financial freedom. See you in the next video.